It's cheaper for us to invest with money borrowed from our life insurance policy than it is for us to use money from our own bank account. My name is Darius.
And I'm Carmen. In this video, we are going to share with you the epiphany we had once we understood this information. And we're going to show you how to do the exact same thing, all by just telling the story of how we got to this process. Now, before we jump into this information, what I please ask of you is that you subscribe to our YouTube channel, because we recognize that 69% of our audience is not subscribed, and it would significantly help our channel grow on YouTube if you just do us a small favor, free small favor, by just hitting that subscribe button. So please consider if you find value from our videos.
Right, now let's jump into how we learned about this strategy. Since investing in real estate for about 10 years, we've always used OPM.
Always.
Other people's money.
Always. Like, we have never invested in a real estate transaction using our own money. And the reason being is because
we didn't have any.
Especially in the beginning, we didn't have the money to do. So we always had to use OPM. Now, if we paint this picture, I'm going to go through this very quickly, is through this journey of understanding how we got to whole life insurance is the fact that, number one, we would start off using hard money. And what hard money is it's funding outside of a traditional banking institution. So when I say that, I mean, we're not going to Wells Fargo or Bank of America. We're going to a business that is legally able to lend money. And the reason why they call it hard money is because the money is going to be secured to a hard asset. So anytime you go to this type of institution, you are putting your house up, right? Or whatever real estate transaction, in our case, you're putting that up in exchange as collateral. So the idea behind this is hard money is accessible, but it's expensive. The interest rate is going to be probably about 20%, definitely north of 15%, right? And you're going to have the money for a short period of time, meaning 6 months. Additionally, there are fees that are tacked on, and there are points, which is percentages, like 1%, 2% of the transaction that could be added on the front or the back end of the transaction. So you can see how this gets expensive very quickly. And unfortunately, we had to pass up many real estate deals because the hard money was just too expensive. Like, the margins were just too narrow, and it didn't make sense for us to invest. So once we then learned about private money, meaning we would get money from just an individual, a private person outside of a financial institution who maybe had money in their savings account and wanted to earn more interest. Now, when we made this transition to private money, we were able to significantly change our costs from 20% with hard money down to 10% interest with a private money lender, and we could extend our loan out for sometimes as long as a year. And this was really significant for us because sometimes with different transactions that we were doing, maybe we could do 1 or 2 transactions each year as opposed to just being subjected to one real estate deal per transaction.
Right, and the thing with that hard money is we had to actually attach that address to that loan. When we had private money loans, we just had the money and we said we'll pay the 10% interest, and we could do multiple deals within that year.
Absolutely.
Now, lastly, what happened is one of our private money lenders we came across, because we had to continuously find more private money lenders to continue to fund our deals, is we came across a private money lender that invested with us for 5 years at 10% and no points or fees. Yeah. The only difference between him and everybody else is the fact that he used his dividend paying whole life insurance policy to invest with us.
Now, before this whole situation, right, we were like, wait a second, I don't know, because our limited knowledge of life insurance was that, like, was he getting money from the death benefit? And I don't know if we really want to do this because we don't want his family coming after us for thinking that we had money, because we just didn't understand this process. Right.
We had checked the box of the term insurance. So we knew we had term insurance, and that was it. Yeah. We just put it on the shelf and didn't think about it anymore. Exactly.
So when this individual said, yeah, I'm going to go move some funds, I'll get money for my life insurance policy, I'll send it to you in a week, we were like, hold on, bro. I don't know if we want to do this. But the point of this video is to share with you why this individual did it and why we are now doing it ourselves, right? So if you want to...
So whole life insurance policy is a type of life insurance policy that covers you or the insured for their entire life, as opposed to term insurance, which covers for a specific period of time. Now, whole life insurance policy also have a cash value component that grows over time.
And that just means there's cash that grows in your policy.
Right. Now, why did he use this cash value? Well, our private money lender had access to more cash than he actually paid for the policy. So he had access to more than what it cost him.
And what that looks like is every time you pay your premium, that the cost for insurance, there's cash that's available. And every year you pay, the cash continues to grow. So that's how you're able to access more and more cash every single year, because when you pay your premium, more cash grows.
Now, the option for this individual was he had two ways of getting access to these funds. He could do it through a withdrawal, which is like going to an ATM, you put your card in and you take the money out of your bank account. The other option is a loan, which is you go to the bank and you borrow their money and you have to pay interest on it. So why didn't he do a withdrawal? Because if I'm going to do a withdrawal, one thing I understand, and one thing that he understood, is that he wouldn't owe any interest.
Yeah.
Because the money came directly from his policy. The second thing is he wouldn't have to pay it back because it came directly from his policy. And I mean, just overall, it's his money. If he makes a withdrawal, it's his money coming from his policy.
Now, this is where understanding how life insurance works is very important, because what we know now with life insurance is if you get a withdrawal, you have to pay taxes on the money that you take out of the policy. And when you take money physically out of the policy in the form of withdrawal, it stunts the growth of the cash.
Right.
So think about like your savings account. This is how I'm trying to paint the picture, is every time you take money out of your savings account goes down, right? And now you're no longer earning that compound interest in the savings account because your account keeps fluctuating.
Exactly.
Right?
I want to hone in on what you just said. The savings account in it isn't earning compound interest anymore because the funds are disturbed.
Yes.
You can't earn compound interest if the money isn't there. In order for compound interest to work, is interest on interest, in that money has to sit. Now, he understood that because what he's able to benefit from is by using the money from the insurance company, his money is still able to grow compound interest because it's not disturbed.
And what Darius is referring to is the loan. The
yes.
second option, meaning the loan. So what we can do is if we see, for example, we have $20,000 inside of our whole life insurance policy, we can call the insurance company up and say, hey, I'd like to get a loan. We do this often. Then they give us the terms and conditions. And I actually just did this last week, and I was told that the interest for the loan that I just requested was $25,000 in this case. The interest on the loan was 4.4%. And what that does is that significantly changes, right, the amount of money that is going to cost us for this transaction.
Well, that's the amount of money that it cost him. We weren't even at that step yet.
Yeah.
This is why he used his life insurance policy as opposed to any other funds, because in order for him to realize the 10% that we were offering, he had to borrow those funds.
Yeah, at a lower rate. Now let me close the door on this loan process, right? So the reason why you would get a loan, or how the loan works, is you are actually going to get money from the insurance company. They are going to see that you have $20,000 or $25,000 in my case, in my cash value, and they're going to give me their money. They, meaning the insurance company, will give me a loan against the cash that is inside my policy, because they're essentially going to use that process as collateral. So that's why we are able to get a loan from the insurance company and continue to use OPM, as opposed to disturbing the cash or the growth with the cash value inside of our policy.
Right. Now, he paid interest because he borrowed money from the insurance company, like you said. He also has to pay that money back because it's not his money. It's the insurance company's money because he borrowed it from them.
Yeah.
And one of the biggest benefits is that he still gets to participate in the guaranteed interest that he earns in his policy,
because he didn't touch the money.
Now, the nice thing about this, or the key to this, is the fact that he lent the money out for more than what it cost him.
Yeah.
That's the key here to understand. He borrowed money at 4 and lent it at 10. That is the biggest thing to understand in this situation, because we did the exact same thing. We borrowed money at 10 and lent it out at 20.
Yeah.
You know what I mean? So everybody wins in this situation. We created a win-win situation for both us, our investor, and the insurance company. But who ends up being the biggest winner in this whole situation?
Well, you know what I want you to do is, because we just glazed over those numbers, I want you to go back and talk about how we were borrowing at 10 and made 20.
Okay.
Break that down a little bit more.
Okay. So we're investing in real estate, and let's say it's 20% interest, like I said.
Return.
20% interest, 20% return per deal. Now, when we're doing hard money, we can only do one deal with that transaction. At 1 year, we're able to do two.
Potentially, yeah.
So that's 20% and 20%. And it cost us 10%. So if we subtract the 10% that it cost us from the 40% that we earned, we're left with 30%.
Yeah.
So that's 3 times more than what it cost us to do this transaction. So we're winning. Now, if I'm thinking about the private money lender, what's his return on his investment? Because he's investing with us at 10%, but he borrowed the money at 4%. So if you subtract 4% from the 10, you're left with 6. That's 1.5 times more.
Yeah.
So that's 150% return on just providing money. It was 300 for us, 150 for him.
But I'm just having a moment here because for somebody like Darius, who these numbers and these percentages just come natural to him, like I just want to take a moment and slow down, because the nugget in this video is about how much money we can make by using a whole life insurance policy. And I don't want to glaze over the numbers that you're sharing, right? So what you were saying is sometimes as the consumer, we just go, oh, if I'm borrowing at 4 and I get 10, oh, I get 6% back, right? And you may think I can do better.
You should.
And you always should. What we also want you to know is, what does that translate? How does that work? And what you were just saying is it's 1.5. It's way more. It's 150%. Where can you do that in this day and age?
Especially when it's not your money and you don't have to do anything but provide the money.
Thank you. Right?
So, and you know what? I want to also talk about the insurance company, because the insurance company wins also because they're collateralizing funds that they already have.
It's a win for them.
It's a win for them. So if they're lending money at 4% or 4 point some percent, the money that they are able to invest is a lot less. So let's say in this situation, they're able to invest at just a little under 4% and get a return. Loans are going to naturally be more expensive, period.
Yeah.
If anybody provides a loan, it's going to be more expensive than what it costs you. So let's say the insurance company makes 12% on this. The insurance company makes more on these loans than they would anything else.
Yeah, any other investment.
It's beneficial for them to do it. So again, this is a win-win situation for everybody. But we look at the numbers and say we got a 300% return on the cost. Our investor got...
Break that down again. How did you arrive at 300%?
So I came at 300% because we were able to do 2 transactions within a year, and it cost us 10%. And the 20% twice is... I'm just saying that it's
20% return that we got from the transactions.
We did it twice. So we say that's 40%, but it costs us 10% for the whole year.
Yeah.
I subtract 10% from 20 just so I can make it simple numbers, and that's 3 times more than what it cost us.
Yeah.
And that's before the transaction. Before we make money from the cash out with a real estate deal. That's just from the contract. The investor, in our situation, we invested with him for 10%. We gave him 10% return on his money that he borrowed at 4. So if you subtract 4 from the 10, that leaves you with 6. Yeah. 6 is 1.5% more than what it cost him to get money.
Yeah.
So both of us are winning to the tone of 1.5 is 150%, and the 3x is 300% more than the cost of us getting a loan.
So that's really the story. We have way more to talk about. But again, the idea is, if we just take a minute and kind of summarize how we arrived to this, right? So in the beginning, we were talking about how we started with hard money. We realized it was too expensive. Then we went to private money. There were some limitations there. And then we realized the nugget inside private money, which was using a whole life insurance policy. And that allows us freedom. That allows us infinite time to be able to pay the loans back, get everything going, and be able to get these returns.
Right.
Now, how this actually works, folks, is you have to pay the loans back, right? That's how this whole process works, is you have to pay the loans back, and you have to be responsible with this whole situation so that it can, you can reap all the rewards.
Right, because there's a cost. If you don't borrow if you're not using your own money and you get it from somebody else, there's a cost that you have to pay.
Always.
And the way insurance companies charge you is, as long as that money is outstanding, they're going to charge you simple interest on the funds that are outstanding. So if you're not using the money, pay it back to the insurance company, because they're going to, since it's simple interest, they're going to reduce the amount of money, reduce the costs based on how much money that is outstanding.
Yeah.
Which is something that we had to realize over the years of us doing it is, hey, if we're not using this money, pay that bad boy back.
Pay back. So it's not costing you money. So now we want to basically kind of transition and talk about the risks of borrowing from a life insurance policy.
Yeah.
So the risk associated, like we said, first things first, you got to pay the loan back, right? And if you don't pay the loan back, what's going to happen is that outstanding balance is going to roll over year after year after year, right? So you have to pay the loans back. And say, for example, if you pass and there is a outstanding balance, that balance is going to get deducted from the death benefit. So
Why is it deducted from the death benefit? Because you use your policy as collateral to get a loan from the insurance company. You put your policy up to get a loan from the insurance company. Remember, it's not your money you're borrowing from the insurance company.
So where this is coming from is we have people in the comments that go, whole life is a ripoff because you don't get the cash value and you only get the death benefit when you die. What we want you to understand is that the death benefit, that the reason why you have cash value is because the death benefit is being siphoned to you while you are living. The insurance company,
you access to it.
The insurance company is giving you access to your death benefit in the form of cash value so that you can borrow and use at your discretion. So if you don't pay that money back, that's why they're going to deduct the balance from the death benefit that they promise you. So simple numbers, let's say that your death benefit is $500,000 and you have a $50,000 outstanding loan and you pass away. What will be passed to your family is $450,000 because you didn't pay back the $50,000.
Right now,
and that's how this whole process works, is because your death benefit is the collateral for this whole transaction.
Now, with that $50,000 that's outstanding, here's another risk, is that you have to make sure the return on what you invested in exceeds the cost of the loan and any associated fees. If the investment doesn't perform as expected, the strategy may not be the best benefit for you.
Yeah. And I find that this is helpful too, because we also know as investors, you should always do your research and your return should always work out, right? As long as you do your due diligence and you know the collateral and everything set up. If for any reason the investment does not go out the way you planned, the sigh of relief that you can essentially breathe is know that you have flexibility in trying to figure out how you're going to pay this loan back. And it's not tacked to the individual, right? It's not tacked to Susie, who's banking on you to pay her money back. And maybe, she borrowed from her retirement and now she needs that money. Like, it gives you the relief in knowing that this is on me. This is my policy and I have time in order to pay this back. And if not, then I just know my family is going to get a little bit less than the whatever the balance is owed.
Right. So again, make sure what you use the money to invest in, that you actually get the money back that you invested in. Now, one of the things that I liked about this is when we borrow from our life insurance policy, it doesn't go against our credit.
Oh, good point.
We don't have to worry about credit.
Good
so
point.
Initially when we started, they would pull your credit to make sure that you're able to get this short-term loan. With borrowing money from our life insurance policy, it doesn't matter what our credit is, because they're using the actual policy as collateral. So that's very, very beneficial for us investing, or people that are in the process of buying a house and don't want anything to touch their credit or whatever. You're fine. Now, with everything that we said, we talked about the people that benefited from this transaction, us, the investor, and the insurance company. I think we are the biggest winner in this situation, because the insurance company got billions of dollars and our little $50,000, $25,000 that we invest didn't do much for him. Our investor, we do better in our investor because he already knew this information. We're the ones that really came up, not just because of the interest, but because of what we learned through the process of this transaction.
100%.
So it also flows into, we're the biggest winners because of how we actually use our policies to invest. And we actually use our policies to invest in rentals, long-term rentals, duplexes, and notes. And this allows us to invest in assets that generate long-term cash flow and requires little attention. This is important for us, is because aside from the money that we make, if we're talking about generational wealth, it's not about how much money you pass over. It's about the information that you pass over.
Totally.
And with these long-term rentals, what we're doing is we're investing using money from our policies, but we're also learning the process so we can change that process or teach that process over to our daughter so that regardless of how much money that she has, because $1 million today isn't going to be the same $1 million 10 years from now.
Yeah.
It won't be the same $1 million a year from now.
Totally.
So it's important for us to pass on this information more than the money as to how we're using the funds.
Yeah, absolutely. And I agree with you. With just having this knowledge and knowing that we can do this, it's completely changed our ability to create and sustain financial freedom. Because before we knew this information, we were very much still stuck in the rat race, doing the same things over and over again. And it wasn't until we had this information where we were able to put it into practice. We both retired from corporate America and created our own business, teaching people how to do this process because of the value that we find in it. So if you want to start a policy or you want more information, then click on the link below. We would love to serve our Wealth Nation family.
Remember to own your own lifestyle,
or someone else will.